Hello students, welcome to the lecture on Introduction to Financial Management. After this lecture, we will be able to learn the following objectives. Explain the importance of financial management, describe the interrelation among financial decisions, explain the functional areas of modern financial management, discuss the organization of the finance function, and describe the objectives of financial management. Finance. Let us first know the meaning of financial management. Financial management is mainly concerned with the effective funds management in the business. Meaning of finance. Finance may be defined as the art and science of managing money. It includes financial service and financial instruments. The concept of finance includes capital, funds, money, and amount, but each word is having unique meaning. Definition of finance. Finance is the art and science of managing money, or the word finance connotes management of money. It is the science or study of the management of funds. Definition of business finance. Business finance is that business activity which concerns with the acquisition and conservation of capital funds in meeting financial needs and overall objectives of a business enterprise. Or it can be defined as the activity concerned with planning, raising, controlling, administering of the funds used in the business. At this point, why don't you take a look at this video which gives you quite a good overview of finance.
So what exactly is finance? Well, there's lots of ways we can define finance, but one good definition is that finance is the study of how to make good decisions that involve money. Obviously, there are many types of business decisions that involve money. A few examples of the types of decisions finance cares about is what assets should the firm buy? Or how should we pay for the assets we want to buy? Or even mundane decisions like how much cash should the firm keep on hand. Another way we can think about finance is that finance is the study of risk and return. These are what I like to call the two pillars of finance. They are foundational concepts that almost everything in finance revolves around. So we'll be spending a lot of time in this course trying to measure risk and measure return and understand exactly how risk and return should affect all of our decision making. Another way we can think about finance is to think about the two primary functions of finance. Now, finance doesn't really have strictly defined functions. Like in financial accounting, you may say the function is to prepare financial statements. But at least in general terms, the functions of finance are analysis and decision making. So we're going to be analyzing problems that involve a monetary component and then trying to make good decisions on these problems that involve a monetary component. There are many ways we might try to organize finance into various areas. One simple way we can do this is to divide finance into about 5 different subjects. So the first is corporate finance, closely related to business finance or managerial finance. Those are very near synonyms for each other. That's all about how the firm should make good financial decisions. Then we have personal finance. Obviously, this is about how the individual should make good financial decisions. So this would include things like personal budgeting, financial planning, and estate planning. Then we have investments and portfolio management. This is all about how we should make good decisions involving financial investments, things like common stocks, preferred stocks, bonds, etc. So we want to understand the best way to select those investments and then how to combine them into a portfolio that has attractive risk and return characteristics. Then we have financial markets and institutions. This is a very broad area that overlaps a lot with macroeconomics. It's about how financial markets should be organized and how financial institutions should be managed in such a way that they provide the most benefit for an economy. And finally, we have public finance. This is an area that's a little bit different from the others because it's related to government. So it's about taxes, spending, balancing the budget, and financing public debt.
Let me now explain to you the different types of finance. Finance can be classified into 2 major parts: private finance, which includes the individual firm's business or corporate financial activities to meet the requirements, and public finance, which concerns revenue and disbursement of government such as central government, state government and semi-government financial matters. Definition of financial management. Financial management is mainly concerned with the effective funds management in the business. In simple words, financial management as practiced by business firms can be called as corporation finance or business finance. Though many definitions have been given to define it, it is concerned with the efficient use of an important economic resource, namely capital funds. Financial management deals with procurement of funds and their effective utilization in the business. Financial management as an application of general management principle to the area of financial decision making. It is an area of financial decision making, harmonizing individual motives and enterprise goals. Importance and scope of financial management. Some of the importance of the financial management is as follows. Financial planning. Financial planning helps to promotion of an enterprise. Acquisition of funds. Financial management involves the acquisition of required finance to the business concern. Proper use of funds. Proper use and allocation of funds leads to improve the operational efficiency of the business concern. Financial decision. Financial management helps to take sound financial decision in the business concern. Improve profitability. Financial management helps to improve the profitability position of the concern with the help of strong financial control devices such as budgetary control, ratio analysis, cost volume, profit analysis. Increase the value of the firm. Ultimate aim of any business concern will achieve the maximum profit, and higher profitability leads to maximum the wealth of the investors as well as the nation. Promoting savings. Effective financial management helps to promoting and mobilizing individual and corporate savings. Let us find out the scope of financial management. Financial management covers wide area with multi-dimensional approaches. The following are the important scope of financial management. Financial management and economics. Financial economic is one of the emerging area which provides immense opportunity to finance economical areas. Financial management and accounting. Accounting records includes the financial information of the business concern. Financial management or mathematics. Modern approaches of the financial management applied a large number of mathematical and statistical tools and techniques. They are also called as econometrics. Financial management and production management. Production management is the operational part of the business concern which helps to multiply the money into profit. Financial management and marketing. Produced goods are sold in the market with innovative and modern approaches. For this, the marketing department needs finance to meet their requirements. Financial management and human resource. Financial management is also related with human resource department, which provides manpower to all the functional areas of the management.
The topic is the role of financial management, and in this video we shall discuss what is financial management, what should be the goal of firm, and introduction to modern corporation. Let's start with the definition of financial management. Financial management is concerned with acquisition, financing, and management of assets with some overall goal in mind. It means that finance manager has to take three important decisions. First one is the acquisition of assets, which is the investment decision, that how much value should be invested to acquire the assets. Second one is that what source should be utilized to acquire these assets, that is the financing decision. And third one is the routine decision, which is asset management decision, that how to manage these assets. All these three decisions are taken by finance manager with some overall goal in mind, and what is that overall goal? We shall discuss it after a few slides. So let's talk about these three decisions in detail. First decision is acquisition decision or investment decision. It is related with the left hand side of the balance sheet, which is the asset side. It is most important decision among all three decisions taken by finance manager. Now, finance manager has to decide that what should be the optimal firm size. Firm size is represented by the total value of assets of the firm. And after finalizing the optimal firm size, it should be finalized that what specific assets should be acquired. Normally, there are two main types of assets in the balance sheet of a firm: current assets and fixed assets. So it is the job of finance manager to decide that how much should be the optimal level of current assets and what should be the optimal level of fixed assets. And if any case, what asset should be reduced or eliminated. So these are few examples of investment decisions taken by finance manager. Second important decision is financing decision. It is related with the right hand side of the balance sheet, which includes owner's equity and liabilities. Owner's equity and liabilities are sources of funds. So finance manager decides that what is the best type of financing available to the company, and what is the best financing mix, and what is the best dividend policy, and if need arises, how the fund will be physically acquired. So all these three decisions are known as financing decisions because it is related with the provision of funds to the business. Third important decision is asset management decision, which is a routine decision taken by finance manager, and it is related with the management of current assets. Current assets include the cash balance, the accounts receivables and inventories, etc. So these current assets are required to be managed on daily basis and in routine finance operations. So these three decisions are taken by finance manager with some overall goal in mind. There is some overall goal which finance manager wants to achieve, and what's that goal is? That goal is maximization of shareholders' wealth. Shareholders' wealth maximization means maximization of share price, because share price is the barometer to evaluate the performance of the business. Now, why the shareholders' wealth maximization is considered as the ultimate goal of the firm? Because we can say that why not the profit maximization? Why not the maximization of earning per share? So there are few shortfalls or shortcomings of some alternative objectives, because of which we say that maximization of shareholders' wealth should be the ultimate goal. For example, if we say that the ultimate goal of the firm should be profit maximization, that is maximization of firm's earning after tax, and it has certain shortcomings. For example, profit can be increased while harming the firm by, for example, deferring maintenance or by issuing common stock to buy treasury bills. So this will no doubt increase the profit of the business, the earning after tax of the business, but by issuing common stock, if you are buying T-bills and getting returns, then this will dilute earning per share. So it should not be considered as the ultimate goal of the firm. Second important goal which we can say that should be the goal of the firm is maximization of earning per share. So again, due to the same reason that it does not specify timing or duration of expected returns, and also it ignores the risk level, so that's why this should not be the ultimate goal of the firm. And if earning per share maximization is considered as the ultimate goal of the firm, then it means that we are going for a zero payout dividend policy. So if you are not paying dividend, definitely the shareholders will not attract towards your company. So that's why earning per share maximization should not be called as the ultimate goal of the firm. Now, there are certain strengths of shareholders' wealth maximization. Now, because share price serves as a barometer for business performance, therefore if share price is increasing, you can make a guess that firm is performing well. And if the share price of the company is decreasing, this means that the firm is not doing good. And it also takes into account current and future profits and earning per share and timing, duration, risk of profits, dividend policy, and all other relevant factors. So that is why shareholders' wealth maximization should be called as the ultimate goal of the firm. Now, from financial management viewpoint, there is an important character of modern corporation, and this is separation of ownership and control. Shareholders are the principals and they appoint management, who is the agent. An agent is assumed to act on behalf of the principal and in the best interest of the principal. But this is not the case always, because management has more operating powers and they can use or they can exercise their powers to get private benefits. So to stop management to work for their personal benefits, shareholders are required to provide them certain incentives. And this situation of separation of ownership and control creates a problem which is known as agency problem. Now, agency problem basically states that principals must provide incentives so that management acts in principal's best interest and then monitor results. Who are principals? Shareholders. Shareholders are the principals. So shareholders must provide incentives to the management to enforce management to work in the best interest of the shareholders. What sorts of incentives shareholders can provide to management? These incentives include stock options, perquisites, bonuses, and other similar types of incentives. These incentives enforce management to work honestly and in the best interest of principals. Now, finally, the important issue is social responsibility. We have considered wealth maximization as the ultimate goal of financial management. But this wealth maximization goal does not preclude the firm from being socially responsible. Simply speaking, we can say that the goal of wealth maximization should not be achieved at the expense of the betterment of the society. So this means that firm should not engage itself in activities which are harmful for the society to get profit or to maximize the wealth. So if we say that the ultimate goal of the firm is to maximize shareholders' wealth, we assume that the firm is socially responsible. Firm is not doing a business which is harmful for the society or the environment. So if the firm is socially responsible, then we can say that shareholders' wealth maximization goal is the perfect and the ultimate goal of financial management and is the ultimate goal of the firm. Thank you for your time.
Interrelationship among financial decision. All the major function or decision, investment function, finance function, liquidity function and dividend function are interrelated and interconnected. They are interrelated because the goal of all the function is one and the same. The ultimate objective is only one: achievement of maximization of shareholders' wealth or maximizing the market value of the share. All the decisions are also interconnected or interdependent also. No function is superior. All the functions are important. Importance of the function depends on the situation of the firm. Nature of financial management. The nature of financial management is a relationship with economics and accounting, its function and its scope. The modern approach to financial management is to find out how much money is required by the company in question and then to source at least that amount. When raising finance, a financial management team should ensure that they strike a balance of owned and borrowed funds. An important decision of financial management is how much to pay the shareholders and how much to retain as working capital for the business.
Okay, so let's have a look at the purpose of financial management, the whole reason for financial management. Okay, so its key objectives. You're the financial manager. You're in charge of where the money goes, how to get the money in, that sort of thing. And the objective you have to keep in mind: create wealth for shareholders, shareholder wealth maximization. Also thinking of generating cash. We're not just talking about profits here, we are talking about the link between cash and wealth, the link between cash and profits. For example, it may well be that you think, right, if I offer a long credit term, I will get more customers. More customers will generate wealth. However, with a long credit term, they won't pay you for a long time, and so they won't generate cash. And it's weighing up those two problems. So you want to generate cash, you want to create wealth. Difficult to do them both at the same time, particularly at the beginning. And then finally, you've got some cash, you've built up some cash, and you think, right, okay, now I need to decide where I'm going to invest it. Or do I actually give it away as a dividend? But let's say that we invest, then you've got to decide, right, what investment do I need to take on? And obviously we're going to have a look at during the course how to evaluate returns on these investments. Okay, and then finally, one thing, it's linked to this, and it's good that this comes up here. It's very easy when looking at investment appraisal to just look at the numbers and not think about the different risks that are attached to them. And obviously the more risky something is, then the more return it is, and the risk can be built in, as we'll see later on in the course. However, one point that I want to make clear here is this exam is not purely numbers. Okay, a lot of it as well is all about explaining the investment techniques, etc. Okay, back to the purpose of financial management then. We've looked at the objectives. How are we going to go about doing those? What is the financial manager's job? Well, as we said, he needs to plan. He needs to plan to see what cash he's got available at any given time in order to pay off creditors, etc. And he needs to think of cash not just in the short term, but medium and long term as well. Thinking of investment appraisal in the long term maybe, and short term, as I say, paying off creditors, that sort of thing. The other thing, decision making, we've spoken about that already, the investment appraisal, that sort of thing. And we said, look, in order to invest, then we need to get some money. That money can either come from profits, or it can come from debt or equity as well. Okay, so we're going to have a look at which companies would be better off financed by debt, which would be better off financed by equity, etc. Okay, how to use those profits. I did quickly mention we could either invest or we could give away a dividend. Okay, some companies give away high dividends, some give away low dividends and choose to reinvest that. When is it best to do that? What's the consequences of that we'll be looking at? Okay, and then finally in the middle then we've looked at financial planning, we've looked at decision making, also just controlling the whole thing as we go along. So making sure that the returns on investment are right and we're using up our assets efficiently, and that we're always looking right back to the start of what I said, to manage and act in the best interest of the shareholder. Okay, thanks a lot.
Functional areas of modern financial management. Some of the functional areas covered in financial management as determining financial needs. A finance manager is supposed to meet financial needs of the enterprise. For this purpose, he should determine financial needs of the concern. Choosing the sources of funds. A number of sources may be available for raising funds. A concern may be resort to issue of share capital and debentures. Financial institutions may be requested to provide long-term funds. Financial analysis and interpretation. The analysis and interpretation of financial statement is an important task of a finance manager. He is expected to know about the profitability, liquidity position, short-term and long-term financial position of the concern. Cost volume profit analysis. This is popularly known as CVP relationship. For this purpose, fixed costs, variable costs and semi-variable costs have to be analyzed. Working capital management. Working capital refers to that part of firm's capital which is required for financing short-term or current assets such as cash, receivables and inventories. It is essential to maintain proper level of these assets. Dividend policy. Dividend policy is an important area of financial management because the interests of the shareholders and the needs of the company are directly related to it. Capital budgeting. Capital budgeting decisions are vital to any organization. Any unsound investment decision may prove to be fatal for the very existence of the concern. Organization of the finance function. Finance function can be divided into three major decisions which the firm must make, namely the investment decision, the finance decision, and the dividend decision. Investment decision. It relates to the selection of assets in which funds are invested by the firm. Assets fall into two categories: long-term assets which fall yield return over a period of time in future, short-term current assets which are convertible into cash in the normal course of business, usually within a year. The asset selection decision of a firm is of two types. Capital budgeting decision. It is the most crucial financial decision of a firm which relates to the selection of an investment proposal whose benefits are likely to arise in future over the lifetime of the project. Liquidity decision. The liquidity decision is concerned with the management of the current assets, which is a prerequisite to long-term success of any business firm. The main objective of the current assets management is trade-off between profitability and liquidity. Financing decision. The second major decision of the firm is the financing decision for determining the best financing mix of the firm. It covers two interrelated aspects: capital structure theory and capital structure decision. Dividend decision. The dividend decision should be taken in terms of its impact on the shareholders' wealth. The optimum dividend policy is one which maximizes the market values of share.
Financial objectives with shareholder wealth maximisation, because shareholder wealth maximisation is actually judged by the share price, and obviously the share price increasing is normally due to profits increasing. That happens most of the time. However, there can be occasions where this could happen, where the share price goes down and hence shareholder wealth maximisation goes down. So always think of shareholder wealth maximisation as being the effect on the share price and the effect on dividends, but we'll come to that later. So anyway, the share price could go down while actually profits are going up. So you might think, right, the financial objective of profits, fantastic, we've done that, and yet the shareholders aren't better off because the share price has gone down. Now the reason for this could be the nature of the profits. Are they just very short-term profits? Do you not have many products in the long term that looks as if it could keep up those profits? Did you during the year get a huge loan and that's why the profits have increased, but the shareholders don't think that that loan is worth it, that you can be able to pay it back in the future? So whatever the reason might be, could also be, of course, that you've expanded into markets that the shareholders don't like, or that you're using low-cost products or paying low wages that the shareholders don't like. So don't always confuse shareholder wealth and profits, basically financial objectives such as profits. The other point I wanted to quickly mention up there, was share price. Always, obviously, shareholder wealth maximisation. Not only is it more important than profits, but it's pretty much the whole idea of F9. That's what F9 is all about. It's all about shareholder wealth maximisation. How we do it through investing, through financing, through your dividend policy. Okay, so that's what we're getting at the end. Anyway, as I was saying, the other thing I wanted to mention was corporate strategies and how they are much wider than the financial objectives. Okay, now the financial objectives such as profit and EPS, they're actually quite narrow compared to the much wider corporate strategies of quality, customer satisfaction, innovation. Okay, now the whole idea of a corporate strategy, you might be right. What we want to do is, if you're running the Richard Clark Academy, you would say, right, okay, what I want to be is I want to be quite innovative. I want to be the college that changes everything, the college that is always on the cutting edge of new learning techniques, etc. Now, that's not just because the academy wants to be the best. Obviously, it does want to be the best, but ultimately, of course, it does want to increase its EPS and it does want to increase profits. So we're not saying that financial objectives are less important in the end. It's just that corporate strategies such as innovation and customer satisfaction are often wider in terms of what they're looking at But ultimately, they are trying to get to an increase in profits, an increase in EPS, unless, of course, you're a not-for-profit organisation. Okay, so financial objectives, yes, they may be, for a normal company, the ultimate aim, but to get there, you might want to go for something a bit wider, for corporate strategies like those that are a bit wider. Hope that all helped.
Objectives of financial management. Objectives of financial management may be broadly divided into two parts, such as profit maximization and wealth maximization. Profit maximization. Profit maximization aims at maximizes the profit of the concern. Profit maximization consists of the following important features. Profit maximization is also called as chasing per share maximization. Ultimate aim of the business concern is earning profit. It shows the entire position of the business concern, help to reduce the risk of the business. Favorable arguments for profit maximization. The following important points are in support of the profit maximization objectives of the business concern. Main aim is earning profit. Profit is the parameter of the business operation. Profit reduces risk of the business concern. Profit is the main source of finance. Profitability meets the social needs also. Unfavorable arguments for profit maximization. Following important points are against the objectives of profit maximization. Profit maximization leads to exploiting workers and consumer. It creates immoral practices such as corrupt practices, unfair trade practices, etc. Its objectives leads to inequalities among the stakeholders such as customers, suppliers, public shareholders, etc. Drawbacks of profit maximization. Profit maximization objective consists of certain drawback also. It is vague. It ignores the time value of money. It ignores risk. Wealth maximization. Wealth maximization is one of the modern approaches which involves latest innovation and improvements in the field of the business concern. Wealth maximization is also known as value maximization or net present worth maximization. Favorable arguments for wealth maximization. It's superior to the profit maximization because the main aim of the business concern under this concept is to improve the value or wealth of the shareholders. It considers a comparison of the value to cost associated with the business concern. It considers both time and risk of the business concern. It provides efficient allocation of resources. It ensures the economic interests of the society. Unfavorable arguments for wealth maximization. Wealth maximization leads to prescriptive idea of the business concern, but it may not be suitable to present-day business activities. It is the indirect name of the profit maximization. It creates ownership, management controversy. Management alone enjoys certain benefits. The ultimate aim of the wealth maximization objective is to maximize the profit. Wealth maximization can be activated only with the help of the profitable position of the business concern. Summary. Now in the end, let us summarize what we have learned in this lecture. Finance is one of the important and integral part of business concern, hence it plays a major role in every part of the business activities. Financial management is concerned with the duties of the financial managers in the business firm. The nature of financial management is a relationship with economics and accounting, its functions and its scope. Profit maximization is also called as chasing per share maximization. It leads to maximize the business operation for profit maximization. Wealth maximization is one of the modern approaches which involves latest innovations and improvements in the field of the business concern.